So we're going to start looking at accounting just as a first look of why do we even care about it. The whole point of this class is to try to figure out how much things cost. And most of the information you'll be getting from that will be through an accounting system. So you really do have to have a deep understanding of the accounting system. In addition, understanding accounting is going to help you as a manager in the future. And this is something that we hope all of you will be doing, be able to manage a particular unit for profitability. We're going to talk about that in this video. So accounting is a historical enterprise. Now the emphasis is on historical, because what it does is it actually looks at what happened in the past, not what happens in the future. Like if you think you're going to buy something for an investment that you're going to make a lot of money on, that is not recorded in the accounting system. If you actually buy the item, that is recorded, but the potential profit is not. So it's historical. It also measures money. It doesn't measure carbon. It doesn't measure social capital. It doesn't measure human life. It doesn't measure quality. It really just measures monetary money. And that's important to understand that limitation. It's also related to an entity. I'm going to talk a little bit in a minute about entities, so just keep that in mind. That probably should have been the last bullet because I want to actually illustrate something about that. And it's only recorded when a transaction occurs. So if you have an investment in the stock market and the price of that stock goes up, you say, oh, I made some money. But in accounting, you actually don't record that until you sell the stock. So a particular transaction has to occur in order for it to be recorded in the accounting, an event. And that's kind of important because we want to make sure that everything event is recorded, but only events are recorded. There's also a whole bunch of rules that are governed by the Financial Accounting Standards Board and general accounting principles. There's another A there, and I don't know what it is, but there are rules that govern the way things are accounted for, and that's what a CPA is tested on, is on those rules, about how to apply those rules and how to go through the transactions. So it's very complex. What we're going to be doing in the next couple weeks is a very quick overview of accounting. Obviously, accounting majors do this quite a bit in their whole career. Now let's return to the idea of an entity. So we have two entities here, you and a bank. And what happens is these are different things. You are different than the bank. And so when a transaction happens, you actually will record it differently. For instance, if you take money, you have a dollar bill, and you bring it to the bank and you deposit it, those are going to be completely different. As an entity to you, that's a minus. You take away money. But for the bank, it's a plus. So you can see that this transaction, if you drew your boundaries around you as a person, you would record a negative. If you record it as a bank, it would be recorded as a positive. So it's really important to identify the entity that you're going to be recording as. Now, accounting, there's really two types of accounting. One is financial and one is managerial. In financial, the main focus is external users, the people that are interested in your books from the outside of the corporation. These would be investors, creditors, customers, tax authorities, so that anybody in the stock market would want to know. This is often reported through filings or through annual reports. The other type of accounting, managerial accounting, is probably the one that you would be most interested in as an employee of a company, which is for internal use. And this is for management, it's for action, it's for understanding what's going on in the firm. There often is more detail, more operational information in a managerial accounting than there is in financial. Financial is often more sort of the finances of the company, what are the debt obligations, things like that. But for a managerial accounting, you would want to know how these things actually affect your decision making. So now we're going to move to looking at the general accounting equation issues. Now, the way we look at this is I often draw circles around things that are assets and things that are liability and equity. You can see the size of these circles. They're supposed to be the same. I think they are pretty close to the same. The assets are always going to be equal to the liabilities plus equities. So keep that in mind. Assets, though, are things that the company owns. computers, factories, they have money in the bank, they have inventory, they might have a patent, they have furniture, they have machinery, whatever it is the company owns, those are the assets of the firm. Now again, they need to be a bit tangible. There are some intangible assets like patents or like goodwill. We're not really going to get into all that complex parts about the assets, but they generally are something you can see or feel or sell, and especially in value. And that's equal to the liabilities of the firm and the equity. And this has to do with the ownership. Liabilities are things that we owe to a bank, and equity is things that you owe to the owners of the bank. But always that is going to be that equation. So another word for liability is debt, and another word for equity is ownership. So keep that in mind, kind of. Now let's look at like a parallel to a home, because most of you are probably familiar with homes and how people buy homes. So I have this value of this home. Let's say it's $600,000, and what happens is I get a mortgage for that because I actually don't have $600,000 sitting around. So I get a mortgage for that, and let's say it's $350,000. So that's what the bank owes me. I mean, I owe the bank. So part of this home is owned by the bank through the mortgage. The other is the equity portion, and it's really the difference between $600,000 and $350,000, which is $250,000. So that's the equity we have in the firm. Now, I live in this house, most definitely, but the equity I have in it is $250,000. So keeping in mind always this general accounting equation that assets is equal to liabilities plus equities. This is going to be the standard for what we are doing in accounting. Always keep that in mind. And we're going to move now on to how actually that gets expressed in financial statements, and then how to record those things. So the balance sheet is the first financial statement that we're going to be looking at. A balance sheet is a report that indicates the assets, liabilities, and equities of a firm as of a particular date. So it's a snapshot. It's not for the period of last year, it's actually a point in time estimate. And that's different than some of the other reports. So keep that in mind. It's a snapshot. There's going to be assets reported. So those are the things that I listed in that left-hand bubble: cash, inventory, things like that, fixed assets. There's liabilities. So this is things that we owe to other people: long-term debt, short-term debt, accounts payable. We owe this to people. And then there's equity. So this is the owner's portion of it. Owner's equity, retained earnings, invested capital. There's a lot of words for it, but it really means the owners have that. So we see assets, liabilities, and equity, and we also notice that the sum of all the assets is equal to the sum of liabilities and equities. So remember, that's the general accounting equation. Also, there's something called current assets and current liabilities. Current assets are the assets that will turn over in less than a year. So cash turns over quickly. Accounts receivable, that's when people owe you money. Or inventory, you use up inventory pretty quickly. You replenish it, but it's turned over within less than a year. And then on the other side, liabilities, this is also things that are turned over in less than a year. Short-term debt by definition is less than a year. Accounts payable is you owe your vendors money, and you will pay that in less than a year. So current liabilities and current assets are a special class of liabilities, and the difference in the two is called working capital. And we'll reference working capital later on, but I just wanted to define it for you. Working capital is equal to current assets minus current liabilities. So in this case, it's $1,000 minus $400, or $600 is our working capital. So looking at assets, we have both current and long-term. Again, that breakdown is between those that are less than a year and those that are greater than a year. And the same as on liabilities. We have current and long-term. Owner's equity pretty much just has long-term. There's not really such a thing as short-term owner's equity, but that'll be also indicated there. Also remember that anything in accounting, the way we record things is if it's a positive number, we write the number, and if it's a negative number, we write parentheses around it. That's just the standard for recording accounting. So we're going to move now on into the next video into looking at how to record transactions using the starting place of a balance sheet.